I'm Eddie Cannell.
I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show. It is June 1st. It's a Wednesday, and this is our interest rate update. Be sure to subscribe, like, comment, of course. And, if you're out there wondering what we're doing here, we're giving you not financial advice. We are giving you, this is informational purposes only.
That's right, because we're smart, but we're not that smart.
And we're going to go right into where interest rates are today. We see the 30-year fix, right? We did the update yesterday, but everything's the same.
Across the board.
Yeah, 4.875 for the 30-year fix. The 15-year fix at 4.125.
The 5-year ARM, 4.49. The 30-year FHA, 4.25. The 30-year VA, 4.25. Exactly the same down the entire list as yesterday.
Yeah. It's been volatile. I mean, yesterday, in the middle of the day, there were even changes, but we're right back where we were essentially yesterday morning. The quotes that we've here above have no points. There's no extra fees for these. And these are the loan assumptions here below for the conventional FHA and VA loans. And we're going to talk about today, try to go through this quickly, the Fed rate.
This is like a treasure chest where you dig in and you pull up this like awesome matrix. This is phenomenal, actually.
Yeah.
This is unbelievable.
So for maybe the next 10 months, we're going to be looking at this a lot. And a lot of people are confused about what the Fed rate, how often they meet, what the rate is. Like, what is the rate?
Yeah,
I heard the Fed is going to increase rates.
Right.
And they think that there's a direct correlation or if the Fed increases interest rates, the mortgage rates immediately follow. It's actually the opposite. It's the Fed indicates what they're going to do, or they have their meetings, they talk about what they want to do. The moment they speak a word, give us any of their plans, the mortgage market moves fast and first. So the moment the Fed's talking and giving us their agenda, the mortgage rates are moving.
That's right. Yeah, they actually anticipate, the mortgage rates try to anticipate exactly what the Fed's doing, and it's easy because the Feds are telling them what they're going to do before it actually happens. And that's why they call it the target, Fed fund rate, because it is a target. They are pushing, they are trying to target to control good and bad things within the market.
Okay, so we had our last meeting May 4th. The Fed put the rate, it was a 50% or 50 basis points, so it's a 0.5% increase. So the Fed rate is now 0.75%. The next meeting is in a couple weeks. It's June 15th. It's going to be a Wednesday. And if you notice that these dates, these are all the future dates. These are all Wednesdays. Mm-hmm. And so June 15th, there's an 82% chance they're going to raise the Fed rate 0.5%. Okay, so that's what we know. And the reason where these numbers come from are from basically the traders, the Wall Street traders who are betting based on what the Fed has told us they're going to do. This is what they're betting.
Right. And they have true incentive to bet as honestly and as correctly as possible because they have money on the line.
That's right.
I mean, so when they say these chances, this is about as good as it gets on a bet, on a guess.
Yeah, this is coming from the Chicago Mercantile Exchange, and so these are the trades that people are making. And this is the probabilities. It's almost like, hey, what are the Vegas probabilities of the Patriots winning?
Anything? Right. Right, exactly. If you were forced to put $1 million, on a game, on a situation, what would you say that the chances are? You would be forced, because of all your money on the line, to come up with the most accurate guess possible. It is just a guess.
Yeah.
But yeah, just fascinating how this works. And these are just not probabilities upon probabilities. This is, if you go all the way down to February 1st, 2023, that is the chance today.
Yeah.
On what they think they're going to do almost, 9 months from now. So it's not just, that's not a previous chart. That's actually, they're guessing today on all future dates and meetings.
Right. So this is to educate you, but also so that you can, when you're talking about the Fed rate and your mortgage interest rates, that you also can kind of have an idea of what that means when it comes to getting a mortgage, and just this is something more important today than it used to be in the past. Mm-hmm. And I say it used, it's always been important, but no one's really talked about the Fed rate. Have you ever noticed that we're talking about the Fed more and more and more? Like,
yeah,
it wasn't
the
something
Fed's
I mean, the average common person on the street is talking about the Fed more and more.
Mm-hmm.
So, because they dictate so much of our financial day-to-day, the real estate business especially.
Mm-hmm.
But we wanted to show you these future date meetings. July 27th, 94% chance it's going to go up another 0.5%. So when you hear anybody say, hey, I heard on June 15th it went up 0.5%. I heard in July 27th it went up 0.5%.
Yeah.
The answer is, yeah, so what? That was already, that's old news. That was already anticipated.
Right.
It's already old news that on September 21st, if rates do go up 0.25%, that's already known.
Yeah. I mean, another way of putting this, I'm trying to think of an example. I love analogies and examples is, if you're getting gas, they may say, hey, we are predicting in February 1st, 2023, that gas is going to cost $6.25. Okay. There's a 94% chance that gas is going to cost that. What would you do? You'd be like, oh, I'm going to be driving 10,000 miles a year. So based upon that gas price, I need to have this amount of money set over in my savings account so I can pay for gas. I mean, they're literally telling you what they think gas is going to be. Does it have to be that? No. Mm-hmm. But that's making people do certain things. You're going to do certain things because you hear gas is going to be X amount. So that's their way of kind of forcing people to do things. In this case, they're forcing the actual mortgage, bond market to be moving.
Correct. So we're going to show you these two charts next to each other. Here's the 30-year fixed history of since 1971, and here's the Fed rate in about the same time period. You notice the similarity here in 1986. This is the same. This channel here. The Fed rate doing the same thing. So, yes, the Fed rate and 30-year fixed rates are absolutely correlated. But remember, you see this dotted line I put here? I did that manually there. That's where the Fed wants to go. That's where we just showed you the probability. This is based on their meetings and when their comments to us. This is where they want to go. But look what the mortgage 30-year fixed did. It went there right away. It moved immediately. Okay.
That's exactly how to prove that it works.
Yeah.
Setting the target actually works, but it's done in kind of converse.
Yeah. So we actually believe that we're probably going to be in a recession. Probably by August they'll announce it. But what will happen typically is once we're in a recession, we're probably going to have the Fed change their mind or change their tone. They're going to start saying things like, well, we may not be raising the Fed rate much going forward. So now they'll change their tone. What will happen is the mortgage market will immediately react and could come back down or lower. Now, we don't. That's where we're going to keep you posted on this. But basically where we're at right now is we believe we're going to see the Fed rates go up. It's already baked into the rates. But if we hit recession, we'll probably see the tone of the Fed change.
Yep. And the good news is that if they do announce recession, we're already into it, X amount of months. So it's not like it's just starting. We're already into it. And so that means the end is nearer in sight.
That's right. The first quarter of 2022 was a negative GDP. The second quarter is almost done at the end of June. That'll be probably the second quarter. We'll probably have negative GDP. And we're going to keep you posted on that. But basically, again, what does this mean for real estate? We do not believe that real estate is necessarily going to have any kind of negative downturn, maybe flatten,
right?
Maybe see some more inventory on the market. But be sure to subscribe and comment and like, and we'll keep you posted.
Yep, give us a call too, folks.
Thank you, everyone, for watching our show today. If you have questions, be sure to email us at rates@azmortgagebrothers.com. And be sure to take a look at all of our other videos on our channel.